Hello, my name is Joe Bloodgood. I'm with Boulay Financial Advisors, and with me today is my colleague Nathan Faith. We're going to be talking about portfolio construction today. More specifically, we'll look at asset allocation and rebalancing. We'll look at asset location strategies, as well as asset migration, or how we can move money around strategically. Nathan, how are you doing today?
Doing great. Thanks, Joe.
Great. Well, let's jump right in. Let's talk about kind of what this terminology means and how are some ways we can use it to effectively improve our position. So the first thing we'll talk about today is asset allocation and rebalancing. No doubt many of you have heard of these terms. Maybe there's some confusion about what it actually means. So with asset allocation and rebalancing, we'll use this as an example. A balanced portfolio of 50% stocks and 50% bonds. So as the market changes, that mix is also going to change, right? So if we go through a period where the markets have been volatile and we saw a reduction in the price of stocks, what could happen is now you have a portfolio that's overweight bonds or fixed income. So your 50-50 portfolio in this example turned into 60% bonds and 40% stocks. So that's different than your original allocation of 50% stocks and 50% bonds. And so one strategic thing that we can do is to rebalance the account. We bring it back to 50% bonds and 50% stocks. It's a way to force yourself to buy low and sell high. So you're buying back into those stocks that are at a lower valuation, which with the hope of long-term appreciation of those prices. Does that make sense, Nate?
It does, yeah. And it actually leads us to our next topic, which has to do with asset location. So asset allocation is all about growing your wealth and having it work for you. But asset location's all about minimizing fees on your wealth that really don't add any value. So what we're talking to is taxes. All of us, by and large, pay taxes on our wealth, and it matters when it comes to how we think about our investments. In theory, if our investments were all taxed the same, we wouldn't have to take any additional steps when it comes to what to do with our money besides choose the right portfolio. But our investments aren't taxed all the same. There's really two types. Our income can really be taxed in one of two ways. So first, there's ordinary income, which really is where our bond income is taxed, as well as our income through work or Social Security or pensions. But there's another type of income, how our stocks are taxed. As far as qualified income, that's the income that applies to our stock investments. So our stocks predominantly grow through capital gains, and they also kick out some of their growth in the form of dividends. And those dividends and capital gains are almost always taxed at lower rates than our ordinary income. So here's a side-by-side comparison, and you can see at just about every level, our stock income on the right is taxed at a lower rate that's oftentimes about half of the rate that we pay on our bond income, ordinary income, on the left. And that matters, especially over the long haul. So not only are our bonds and stocks taxed differently if they're all within a taxable account, being a brokerage account, that's the blue account that you see up in front of you, but there are different types of accounts, so buckets of money that can mutate or evolve the taxability of our income over time. So for instance, our 401ks and IRAs, they're really tax shelters. Over time, all the gains and income that's earned from bonds and stocks within our tax-deferred accounts, such as 401ks and IRAs, aren't appearing on our tax returns each year to pay those fees to Uncle Sam. However, all the dollars that we distribute, either by choice, early in retirement, or we're required to later in retirement, every dollar is taxed on that left-hand side of the column through ordinary income, meaning our stock income is really being elevated up to higher rates because of the type of account it's coming from. As far as the third type of accounts, the Roths, those accounts mutate and evolve all income from stocks and bonds into tax-free income. So it really matters how you place the investments that you own into these three types of buckets. How does asset location work? For most folks, it's based off of their tax rates. Higher tax rates dictate which type of account we place those investments in. So where do we start? Well, we typically start with the IRAs, and we identify which investments kick out the most ordinary income, because we want the investments that already are going to kick out ordinary income to be held in accounts that will distribute their income as the same type, the IRAs. So bonds first fill up that IRA account bucket until we either run out of bond investments within our allocation, we run out of IRA dollars. Then we actually move to the Roths, and we start from the other side and identify the investments that have the highest long-term return potential. Because if we're going to have tax-free growth and income, we really want it in our Roths, because we'd rather those accounts outgrow and outperform our other types of accounts that are weighed down by taxes. And whatever investments are left over, that's where we place them in our taxable accounts and try to effectively manage how much ordinary and qualified income is being reported on our tax returns each year. Now, as we transition into retirement, it's tough to move the needle as far as how much money we have in each of these types of accounts. But with planning, we can identify the best mix of not only investments, but also the account types that we're investing in. And we can make some big shifts, big changes within how our wealth is diversified by taking advantage of strategic opportunities with our personal planning. So for instance, if we identify a time frame in which our tax rates are going to be low because our income may be low prior to turning on our Social Security, pension, and required minimum distributions from our IRAs, it's a good opportunity to move money from the green bucket to the orange bucket through what's called a Roth conversion. And with tax rates at somewhat low levels through the tax reform, in many cases we see clients moving significant dollars, tens of thousands or hundreds of thousands of dollars a year, from the green to the orange bucket. Secondly, we can actually move significant dollars from the blue bucket to the green bucket if it makes sense with our asset allocation. So for instance, if we have most of our wealth in the blue bucket, we can concentrate bonds in a newly formed green bucket. Now, how can that work? Typically, our 401ks and IRAs limit how much we can contribute to those accounts each year, but there's a special type of account called a non-qualified retirement account that doesn't have those annual contribution limits, and those come in the forms oftentimes through annuities. So specifically, an investment-only variable annuity is a tool that we use to transfer significant dollars, millions of dollars, from the blue bucket to the green bucket to help our clients keep more of what they earn. And so, Joe, would you want to walk through an example of what that planning and process may look like?
Yeah, absolutely. Thanks, Nate. It's certainly clear that all accounts are not created equal. So let's look at how this might look in practice. And so we go back to our first slide that we talked about with asset allocation. And let's say this is a balanced portfolio of 60% stocks and 60% bonds. So we start with 60% stocks and 40% bonds, and over time, we adhere to this asset allocation. We try to keep people relatively close to that and maintain their original investment asset allocation. Let's say it's a business owner that we're working with, and that business owner has a liquidity event. Maybe they sell their business and they get a big balloon payment or an influx of capital. How does that look when we think about portfolio construction? Well, likely we maintain the same asset allocation. So in this example, let's say 60% stocks and 40% bonds. But we look to put those dollars into different types of accounts strategically. Well, there's limitations on how much we can put into a Roth IRA directly, or an IRA directly, or a 401k account. But now we've got a huge portion of this individual's portfolio in that taxable bucket. going back to what Nate talked about, that's the investments that are taxed every year on their dividends and capital gains. By using an investment only variable annuity that Nate spoke about just a minute ago, we're able to move those dollars from the taxable bucket, in other words, the accounts that are taxed every year, over into that green sleeve you see represented as tax deferred. So we were able to shift hundreds of thousands, if not millions of dollars into that tax deferred bucket, take it off the tax rolls for the present and defer it to a future year when hopefully the client is in a lower tax bracket. Does that make sense, Nate?
It does. And just for reference, through proper asset location, asset migration planning, many clients can keep about a fourth to a fifth more of their earnings each year, which adds up in a big way over time. In some extreme cases, we've seen folks reduce their permanent tax bill by about 80%, which can add up to millions upon millions of dollars.
Yeah, absolutely. In a world when we're typically focused on fractions of percents making big differences, when we talk about these kind of dollars that can be potentially saved by way of our tax obligation, this is really powerful planning. Well, thanks, Nate. This has really been great. I appreciate all your help. Next week, we hope to bring you some more information on another financial planning topic near and dear. We're going to talk about estate planning strategies. Until then, have a great week.